Good evening, everyone. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you so much for joining us tonight. So you might have seen some of these presentations before. Whenever we have a new fund that we're looking to invest into as part of our private equity and venture capital program, we tend to do a presentation sharing some of the analysis we've done during the due diligence. Today, we're talking about Square Peg Fund 6 and Square Peg Opportunities 3. Now, we're doing something slightly different from what we do usually, which is that instead of doing a kind of 1 hour full presentation on the fund, I'm going to spend just 10-15 minutes on introduction to the program and a few numbers and a few kind of a description of the funds. And then we're going to spend 45 minutes interviewing Tushar, who's a partner at Square Peg. So he's going to join in around 10 minutes, and we're going to we have the chance to interview him. Please use the Q&A button if you have any questions for me or for Tushar as the session continues. Happy to try to take your questions. I have prepared a kind of a fireside chat with him to go deeper into Square Peg strategy, some of the examples of the company they've invested in, and kind of trying to understand a little bit better how they do what they do. So let me start. And as I mentioned, there are kind of three pieces. First is a bit of an introduction about our private equity venture capital program and to venture capital as an asset class. Then I'm gonna briefly speak about Square Peg Fund 6 and Opportunities 3 and look back at some of their numbers. And then we're gonna speak to Tushar as soon as he joins in around 10 minutes. So first of all, if you're not familiar with the private equity venture capital program, it's for us a way to help people build diversified exposure to private equity venture capital. It sits within our full suite of product, which you see on this slide. So we have cash management, we have core portfolios, we have thematics, and we have alternatives. Core portfolios is where you should have 60-70% of your money. It's your diversified portfolios across asset classes, equities, bonds, real estate, gold. Cash is obviously cash. You can see the rates there. Thematics, I think, is self-explanatory, and private equity venture capital sits under alternatives. If you haven't noticed, we also launched a private credit offering around a year ago, and as of last week, we actually made it available on the app, so you can actually see everything on the app, and you can subscribe self-service. It's been a great product. It's been very successful. Last year, it gave a 10.3% net return to our clients. But today's focus is not on private credit, it's not on anything else, it's on private equity and venture capital. As I briefly mentioned, our private equity venture capital program is designed to make it very simple and cost-effective to build a proper private equity and venture capital exposure. In practice, it helps people mimic what a large investor like GIC or Temasek or the Harvard Endowment would do for their private markets exposure. There are kind of three pillars of how we try to make it great. One is obviously access to the best managers. So we try to source and screen through many managers and make sure that we only select the best. So we have a very high bar. We try to make the experience as simple as possible. So we do the due diligence. We manage the cash flow. I'll explain that in a second. And we manage all the legal complexities. And we try to make it accessible. So the minimum, in case you're not part of the program yet, is $50,000 a year budget. And with that $50,000, we try to make 5 to 7 commitments per year. So it's south of $10,000 minimum if you go for the minimum amount, which is significantly below what usually you would expect from the traditional investing in a closed-end traditional fund. Usually the minimum is above $100,000, so you'll need kind of $1 million a year to actually build a diversified portfolio. So the idea is, with as little as a couple of $100,000 in 4 years, you can build a really diversified private equity portfolio. How do we make it simple? So there are kind of a few steps to it. First, you need to decide how much is your overall allocation to private equity. As I mentioned, minimum is $50,000 budget a year. You can obviously be much higher than that. With that, we're going to invest in 5 to 7 funds a year, building a diversified portfolio. So we look at different strategies, so buyouts, growth, venture, secondaries. We look at different geographies, US, Europe, Asia. We have some targets that I'll show you in a second. And obviously, by definition, there's going to be different vintages, assuming that you invest over a few years. We do very deep due diligence and talk to the managers to make sure that we are confident that they will continue to return the return they've given in the past. And lastly, but not least, we have managed capital calls. We don't call all the money at once, which is one of the issues that reduce private equity returns. But at the same time, we don't call capital every time there is a capital call, because then once you have a diversified portfolio, it'll end up being 52 capital calls a year, which is messy. So we tend to build a buffer and do a capital calls a year. And in the meantime, you can leave your money in the US dollar cash yield, which actually gives you significant returns on cash. So far, we have done kind of a 2.5 years, a bit more than 2.5 years of investments. I'm not going to go through all the investments. We started with Silver Lake, which is a tech buyout. KKR was a growth fund. We done secondaries with Lexington Partners, another industrial buyout with CBR. Khosla Ventures is our first VC. Today, we're talking about Square Peg, which is a VC fund. So this is perhaps relevant. And then I'm going to go faster here. HIG Capital, Hamilton Lane Secondaries, NMC, also mid-market buyouts, General Catalyst, kind of late-stage growth equity. Veritas, Clear Lake are kind of a specific sectorial buyout. CVC Growth, Vista also sectorial buyout. We just closed a AG. We're finalizing the allocation for an AG European Tech Buyout Fund. And obviously today we're talking about Square Peg, where the allocation is going to be 10% of a yearly budget. So if your budget is $50,000, the allocation is going to be $5,000 to Square Peg. If your budget is $500,000, your allocation to Square Peg will be $50,000. Why invest in venture capital as part of your portfolio? And as you saw, we only have one pure venture capital that we've invested before this, which was Khosla Ventures, with General Catalyst being a late-stage venture capital / growth. We do have a couple of growth funds, CBC and KKR, that we've invested in. So first of all, strong returns. Overall, over the last 2.5 decades, venture capital has returned quite good returns, with 14.3% over 25 years, 14.8 over 15, and 15.4 over 5 years. This is average returns. Obviously, our goal is to, hopefully, we're going to invest in first quartile funds, and so we targeting higher returns than this. This is comparable to PEs, actually slightly higher on a longer time horizon, slightly lower on the 15 years, and also comparable to the NASDAQ and the S&P 500 modified private market equivalent. So, it has been very significant returns. Second point, it has very low to no correlation with public market returns. So it actually enhances your diversification in the portfolio. There are a couple of analyses shown here. One is from Invesco in a paper called The Case for Venture Capital, which shows actually negative correlation with public market, with S&P 500 of negative 0.06, in practice zero, in practice no correlation. And there is another analysis from AngelList on their own seed portfolio, which shows a 0.00 correlation with public market. So in general, venture capital tend to actually add significant diversification to any portfolio, which is one of the reasons why large institutional investors tend to have an allocation to the asset class. And lastly, it provides a hedge against disruption. You get exposure to the very companies that might disrupt the core investment you have in your S&P 500 core portfolio. For example, artificial intelligence is clearly a technology that might disrupt several industries, and obviously venture capitalists are currently focusing on that, on the technology quite a bit. And this is kind of goes across sectors. Now, briefly on Square Peg. Square Peg manages $3 billion, is now been founded 13 years ago, so from 2012, employs around 20 professionals. And as the name suggests, this is Fund 6, so they have 5 funds before this, and Opportunities 3 is the third fund. This is kind of the later stage investment. So they tend to go early stage with the kind of the mainstream fund, and then follow on to some of these opportunities with the later stage fund. The geographical focus is very interesting. They started in Australia and New Zealand. They have an office in Singapore. They make investment in Southeast Asia, and they have an office in Tel Aviv to make investment in Israel. Sectorial focus is on 3 sectors: software as a service, fintech, and artificial intelligence. Full disclosure, they're actually an investor in StashAway. One of the reasons I really wanted to have them in our program is that I'm a gigantic fan of Square Peg as an entrepreneur. And when they invested with us, we actually had several offers on the table, and we picked them because we really liked the way they worked. And so I'm very, very, very happy to actually being able to bring it to our program and being able personally to invest in it as I'm also an investor in the private equity program. You can see a few companies here. I'm not going to go into the details because we have Tushar later, and I'm going to use the chance to talk about some of this company later. But company you might have heard of, obviously, is Property Guru if you're based in Singapore, as well as Canva, who's been a global success, and Stripe, of course, as well. So as mentioned, there are three main areas that have been invested in: software as a service, fintech, and AI. The dark blue is AI. As you can see, in the last couple of funds, the proportion of AI has increased quite a bit. They're still early stage companies, which is why they haven't yet reached the same maturity on the opportunities fund. So opportunity fund is still fintech and software as a service mostly. Now, when you look at their historical performance, SquarePeg has done, their mature funds have done very well. The fund one has done 7.3x returns on the capital invested, so with a 29% average yearly returns. Fund two and three have also returned more than 2 times the money, with 16% and 21% IRR, respectively. The other funds are a bit too recent to really judge them, but they're showing strong potential. 2020 is currently below 1x because they're being conservative on valuation. But when you look at fundamentals, we did quite a deep analysis here. Growth is very strong with 200% average revenue growth last year, with 50% of the companies growing more than 100%. So there is a very strong perspective. This is going to kind of pick up and be in a very strong fund. The opportunities funds have also done quite well, especially given how young they are. The fund one is already at 1.5x, and fund two, which is very recent, is at 1.1x. When you compare those returns to what is called the private market equivalent, in this case, we're using MSCI Equity World, you see that actually SquarePeg in each of their vintages have been overperforming. Each of the mature vintages have been overperforming the market. For the new vintages, it's too early to say, but as mentioned earlier, there is strong signs that the same will happen going forward. Maybe looking at impairment ratio, also strong performance, below the COSLA numbers that we've seen in our due diligence with COSLA, in line with the general catalyst for the early stage fund, and actually 0% impairment so far on the two late stage fund. And again, when you compare to general catalyst, actually quite better than what general catalyst has shown so far. So very strong performance in this sense. Lastly, looking at how it fits into our portfolio, as I mentioned earlier, we have a goal of a geographical goal of having around 60% allocation to North America, 20% Europe, 20% Asia. So far, we've actually been under allocating to Asia and over allocating to both Europe and North America. And the reason is that China has been very difficult to invest over the last few years. And kind of that has, we decided to simply, invest where we find the best opportunities. And so we have under invested in Asia so far. The kind of Asia Pacific angle of SquarePeg with Australia, New Zealand, Southeast Asia on top of Israel enable us to actually bring a stronger Asia focus to the portfolio. As you can see from the slide, this moves the allocation from 5 to 8%. Very strong team. This is one thing that, this is one due diligence that was very easy to do because I know all of them. I met them several times. Very stable team. People have been there for a long time. Paul Bassat and Tony Holt are the two founders. Paul Bassat was actually an entrepreneur, a very successful entrepreneur. He founded a company called Seek, who he IPO'd before becoming a venture capitalist. And as you can see from the profiles of the other people, I'm not going to go one by one, but the partners have been with the company for quite a bit of time, and they have very strong background. Tushar, for example, started his career as a lawyer back at McKinsey and then spent some time as a consultant at Bonson Consulting Group before moving into venture capital investing. And just to set the facts straight, these are two different funds. The allocation is going to be half and half. So out of your 10% is going to be 5% on Fund 6 and 5% on the opportunities. 3, geographical allocation is the same for the two funds: Australia, New Zealand, Southeast Asia, Israel. Fund 6, as mentioned, focusing on early stage investments, while opportunities comes later at a late stage. So in practice, opportunities will most probably invest in the best performing companies of the previous fund, of fund 3, 4, and 5. From a size perspective, the target is $350 million for Fund 6 and 210 for the opportunities 3. They are similar in size to the previous vintages, which were 344 and 209. With fairly concentrated portfolio, 20, 25 companies for Fund 6 and 10 to 15 companies for Opportunity 3. Very standard terms, 10-year term, 5 investment period, 5 divestment period, 2%, 220 on Fund 6, and 120 actually on Opportunities 3. Very standard terms, so I'm not going to go into the details here. If you are not part of the program yet and you want to start investing and you want to know how this works, reach out to one of my colleagues. I'm posting here three of them here. You can also scan the QR code in order to be able to talk to them specifically. Okay, so maybe I'm gonna leave this slide here for a second, and as I do that, I understand, Tushar, that you have joined. Are you here?
Hey, Michele.
Hi, Tushar. First of all, thank you so much, and apologies, I'm 4 minutes late to what I told you I was gonna be. But thank you so much for joining. I'm gonna take away the slide in a second so that we can see each other as well better. As you know, I just gave a bit of an introduction to venture capital as an asset class and a few mention on SquarePeg track record. And as I mentioned to everyone earlier, I prepared a few questions that I would like to discuss with you. I'm gonna, in the meantime, stop sharing my screen so that I can see you, and hopefully you can see me as well. Okay, now I see you. That's better. It feels more personal. So on that note, why don't we start from the personal side? I have known you now for a bit over 5 years, 5.5 years, I believe, close to 6 actually. And when I met you, you were actually still based in Australia, and you were, I guess, about to move to Singapore to set up the SquarePeg office here. And so you've been here for 5 years. How was your journey to Singapore? And before this is just to break the ice, and then we're going to go a bit deeper into SquarePeg and investing.
Sure. Firstly, thanks for having me, and hello to all the listeners. And Michele, as you know, I have all the time in the world for you, so I'm very, very happy to be here. Look, I think I'm what's described as maybe a fourth culture kid. So I was born in India. I was primary school in Delhi. I grew up following that in England, so almost entirely secondary school in the UK before moving to Australia to finish high school and then complete my university education there. And then I also did further studies in places like France and spent a short stint in Singapore during my MBA. But as you mentioned, now for the last 5 years I've been living in Singapore, and so it's really the fourth place I've lived. This one's different because I moved here with my family, and we're loving it. We love being in Singapore. As you know, I'm very passionate about this region and its potential, and so we're very happy to be here. And I think Singapore enjoys a privileged position that I would very hard worked for, where it's really in the flow of ideas and talent. I mean, there was a huge AI conference here on the weekend, and all the leaders and thinkers were here. And I think it's an amazing place to be in the flow of ideas and talent and also capital.
Yeah, I agree. I've been here for 12 years, so I could not say it better. Now, you've been, as you implied, a VC for close to a decade, kind of half of the time in Australia, half of the time in Southeast Asia. What changed in venture capital over the last decade? And if you look forward, what do you think will change, and how is SquarePeg positioning for that change? Being mindful of the fact that when we invest in a closed-end fund, we invest for a decade, and so we need to look forward.
Mm-hmm. So, I mean, I've been investing in this Southeast Asia region from day one. So it's been well over a decade for me investing in the region. But I think your question is more general about what's happened in the industry and what we think is going to happen, I think the biggest trend that we have seen shaping the industry of venture capital, and I think it's a trend that will continue to shape it in the next 10 years, is that when the industry first began, it began in the US. And when you thought about large tech companies, more were formed in the US. And that's where the center of gravity of the whole ecosystem was, and that's where all the talent was. But what we've really seen accelerate in the last decade is that that trend has very much shifted outside of the US. So today, more than half the companies that go on to be billion-dollar plus companies are formed outside the US. And increasingly, they are formed in places like this part of the world, Southeast Asia, Australia, China, Japan, other places. So the trend that we are riding is one where the creation of technology companies that go on to be extremely large has diversified away from being centered in the core market of the US and more specifically in the Valley to being global. And so we think that it's a great time to be investing in these kinds of companies globally. It's a trend that we think is playing out now, so we think it'll only continue. And I think the other major trend that we see shaping the industry is one that we see shaping the world, which is AI. You'll hear me talk a lot about AI as we have this conversation, but it is a fundamental shift in how every business operates. So I think our job at Square Peg is to think about how the asset class of venture and how our business could be disrupted, and to then work really hard to disrupt ourselves before someone else does it. So today, for example, in SquarePeg, we are continually experimenting with a number of different tools, different ways that we can change our processes. A lot of our sourcing, which is the way that we find companies, is already been digitalized. So it's no longer just about having coffees and networking, but there's very much a process in place where we use data points externally to find companies, triage them, put them into our pipeline, and go through them in some kind of methodological manner. And I think that will only continue as we use more and more AI in our own business.
Let me, I'm going to go off my list of questions for a second and double click on AI. Obviously, you said there is a lot going on and it might change many industries. And actually, before you joined earlier, I said that one of the reasons to invest in venture capital is that it's a way to hedge your core portfolio. Some of the companies that might disrupt your S&P 500 holdings might be company you invest in through your venture capital investments. And I think this is today maybe even more true than it has ever been, with AI providing obviously opportunities for disruption. Given you spend a lot of time talking to companies you might invest in, is there any sector in particular that you've been looking at and say, okay, this sector is going to be very, very much revolutionized by AI, given what you're seeing so far? And I know it's early, I know it's happening right now. Is there any kind of a thing that kind of blow your mind recently?
I think that's the opportunity, is that this is one of those technological shifts that is sector agnostic. And any industry or vocation that has a human labor element and sort of standard operating procedure element can be significantly impacted by AI. The industries that won't be are, for example, physical industries. So, but even there is the potential of AI to influence how they operate immense. So, AI will not airplanes, but how airplanes fly and how safe they are and how they handle situations is going to be materially impacted by AI. We invested in a company called Exotigo. So, for example, anytime you look to roll out some infrastructure in a city or build a tunnel through the middle of Singapore, you need to know where you're digging and what you're digging up. And today, when you start a project like that, you go into the archives, you pull out all these old maps of people have mapped out where the pipes are, where are the gas pipes, where's the electricity cable. And that's the way that industry works today. And today with AI and with sensors, you can actually roll some machines over the top and they tell you like what layers exist, like, a kilometer down, and they can essentially 3D map the whole thing for you. And that makes the process of building infrastructure extremely efficient. So even old school industries like building roads or laying some cable have been already starting to be very much transformed by the application of AI. And we see this so pervasively. And I think even if you or your listeners reflect on their day-to-day use of and how they interact with technology, think about how revolutionary the mobile phone was. I think it's the same type of paradigm shift that we can expect, possibly even greater with AI, where all of us have such a massive knowledge leverage walking around with us in our pockets. And I think we're only really starting to see the scratching of the surface and what that can enable for people in all walks of life.
Interesting. Yeah, I'm fascinated by some of these like real life industrial type of applications of AI. I think there is so many and super interesting. Now, I know, and I guess that some of the best companies, the best founders, the most interesting ideas, the companies with the most traction tend to have multiple venture capital firms offering money, right? And so you work in a competitive industry where there are other players talking to the same entrepreneurs. How SquarePeg tries to differentiate itself versus the rest? So kind of what is your special sauce, and how do you make sure that the best founders pick you when they have the choice?
Mhm. So, I mean, the first thing is that you have to find the best founders. So we have to work very hard on finding and then getting access to the best founders, which is something that the firm works very, very hard on. And then once you've been through that process and determined that you want to invest, you have to have an offering that the best founders value and want. And that can come in a few different flavors, if you will. So I think the key value adds of a VC is to provide strategic value add, connect you to experts, help you hire better people, and also connect you to downstream capital. So, for example, you may raise your current round with SquarePeg, but who's going to fund your next round? So we have to have very active, very reputable networks that we can bring to bear to our companies. But a lot of firms can do that. At SquarePeg, I think our source really, and people are often surprised and puzzled when I say this. My advantage is my culture. I think SquarePeg has a particular way of working with its portfolio founders and teams that it supports. It's an approach that I think is stems from a position of deep respect and humility. It's a position that respects that it's a founder's business, not SquarePeg's. We're in venture capital, not in private equity. We don't own these companies. We have a minority stake and a privileged position of ownership on these cap tables. And I think that deep respect through which all interactions are facilitated, that actually in market and when the rubber hits continues to be the surprising source of our differentiation. It's the main reason why we win. And we win almost all the time. It's when founders interact with us, they have a different experience to the one they have with 99% of VCs. It's almost such a difficult thing to actually explain and articulate because on the face of it, there is no sustainable advantage in that. Like anyone should be able to do that. But the reality is that most people don't do it. And we've built a business off the back of doing it.
Yeah, look,
I
and
mean,
actually,
you're pretty well placed to speak to this given your experience
no,
interacting with a number of VCs.
no, in fact, actually, I did mention before you joined, I did mention that when you guys invested in 2020, we actually had quite a number of offers on the table, and we picked you actually exactly for this reason. Like when we spoke about it multiple times, so but we picked SquarePeg because we thought that the conversations we had were of very high quality and was very respectful. I've always thought, I never asked you this, I've always thought that one of the reasons why you have SquarePeg tends to have a slightly different culture from most other VCs is might be that Paul, one of the founders, was a founder himself. Do you think that's true? That kind of that permeated down the group?
I think that's absolutely true. I think that's the genesis of the culture of the firm, and
Mm.
he's was and is a founder, and I think um, that ethos of deep respect has definitely come from that. But that is alone is not it. I think to augment that, we've had. I mean, we're a team of 40 people now spread across the world. And this is not something that you can dictate down,
Yeah.
down the organization. So this is really driven. It's a core value. It's a value that we use to hire people. It's a value that we use to not have people anymore that don't have this value. So it's very much something that permeates throughout every member of the team, and irrespective of whether they've been a founder themselves or been an operator themselves, SquarePeg's team is extremely diverse in its background. We have people from all different walks of life in the firm, many with investing experience prior, many not. But the one thing that we do screen for really strongly is can this person represent the brand and interact with founders in the way that we think is the right way.
Yeah, it makes sense. And I think I can witness that from my personal experience with working with you for over 5 years at this point. Now, let's make it real. So let's talk about companies. So we are in Singapore, so let's look at some of your investments in the region. So you've invested in Property Guru very early on, Doctor Anywhere, Credivo, Peluang in Indonesia, obviously StashAway, and then also global leaders like Canva, Airwallex, and many others. Why don't we talk about maybe Doctor Anywhere? I don't want to talk about StashAway, so why don't we talk about maybe Doctor Anywhere, which is a platform that maybe a bunch of people in the call have used. You know, what can you tell us? Of course, I'm sure there is a bunch of confidential information. What can you tell us in terms of how the deal came about? What is why you decided to invest? What you like about it?
Yeah. So Dr. Anywhere, we've been invested in for about 5 years, give or take, maybe slightly longer. Um, it is the largest digital health platform in Southeast Asia. We invested, 2020 should give it away. We invested during COVID. So we were actively looking at the health as a thematic in the region because we felt that there were many unmet needs in accessing good quality healthcare. And that's how we really proactively found Dr. Anywhere. They didn't come to us with a pitch deck looking to raise money. And often the best opportunities that we find are sourced that way. They don't come to us. We have to go find them. What we loved initially was just the whole thesis of healthcare digitally delivered with no touch, no human touch. At the time, of course, the COVID was sort of happening, and utilization, as you can imagine, of the platform was just going through the roof. So we managed to get access to the investment, and we thought that was going to be the future of the company. That's what the company was going to be. Now I know that as with e-commerce, once COVID disappeared, you can't rely on that digital hook alone. Although in Dr. Anywhere's case, it's really a magical experience for those that haven't tried it. It's like trying Grab for the first time instead of hailing a taxi. Once you do it that way, you never go back to hailing a taxi on the street. And it's the same applies to Dr. Anywhere.
Yeah.
But what we also know that's different to Grab is that telehealth alone is a feature. It's not a business. When you think about the care journey, you have to think about the whole care journey. And at some point, that care journey is not purely online and you can't service it online. So you have to build a network, a care network, where you can take a patient and service them wherever the best place and time is to service them, which could be at home, could be digitally, or it could be in a clinic. And so what Dr. Anywhere has had to do in the last 5 years since we invested is to build out elements of that network. So today, it's not only telehealth, it's also one of the largest specialist chains in Singapore, and it services clients not only from Singapore, but from the whole region. And there are people that it employs in other markets in the region through which it sources patients into Singapore, because Singapore, as you know, is a care destination. So it's become much more omni-channel than we first thought it was going to be when we invested. But I think what it's ended up as now is frankly the right model to deliver the care in the way that meets the patient's need, no matter where they are in their journey.
Makes sense. Very interesting. I understand how COVID might have kind of a play in things in a different way than how they play out after that. I understand that.
Sometimes adventure you have to get lucky. Like you invest on one thesis, but it ends up being a different one. But the different thing is better than the one you invested in the first place.
And I'm assuming that changes in direction, maybe not complete change in direction, but this is, and I don't think this has been a complete change in direction. I mean, as a client myself, it doesn't feel that Dr. Anywhere has changed what they've been doing. It feels like maybe they've added things to their proposition rather than changing. And I think that's something that actually probably tends to happen in most of your investments, I guess, because you come in early enough that the companies will over time develop new ideas, new things, go to new markets, et cetera, et cetera. Is that fair?
Yeah, absolutely. I think it's essentially building out the full digital network.
Makes sense. Look, let's talk about one more company. So I know you're also an investor in Credivo, which is probably less known to the kind of to the public, just because it's a B2B business, but it's very well known within the fintech ecosystem, which I'm a part of, and as one of maybe the more successful fintech in Southeast Asia. So why don't we talk about that?
Yeah. So Credivo, for those that don't know, is if you know about Nubank in Latin America, Credivo is the closest analogy to that in this part of the world. It is also one of the fastest growing companies in the region. It was one of the fastest companies to get to $100 million revenue in the region. Actually globally. So it's enjoyed a lot of sort of secular tailwinds. Uh, I can touch, if you like, on how we found the company, decided to invest,
Yes,
and how the journey's gone.
definitely.
Again, this company was proactively originated. It didn't come to us to raise capital. It was very competitive to access this company. We have a focus on fintech in the region. The SquarePeg is a thematic fund. We don't invest generally in everything and anything in the market. We are focused on fintech, on AI, on SaaS, and we also do look at healthcare as well. So, as part of that fintech coverage, we were looking for models that we thought would fit this market. We had seen the rise of a company called Afterpay in Australia, which sold a few years ago to Block for about 35 billion US dollars, one of the largest tech exits from Australia. And we were looking for analogous models in Southeast Asia, and that's really how we found Credivo. And from there, began the process of diligencing the business, but also convincing the founder to take our capital instead of other people's. And there were some very prominent names trying to give money to the same company. I've been on the board for, oh gosh, like 8 years, 7.5, 8 years. I've been the longest serving board member on that company, other than the founders themselves, of course. And the business has only gone from strength to strength, and I think will be an amazing outcome for the region and really put it up in lights. What's gone according to plan is the initial digital part of the journey. What has changed is a few things. We thought it could be a bigger business and go into adjacencies when we invested. That was a cherry on top. But we didn't think that they would become a full-fledged bank. And today they own and operate a bank in Indonesia. They are one of the main challenger banks, digital banks in Indonesia. They're also expanding very quickly into other countries. And the other thing that we didn't expect is that they would expand very rapidly offline. So again, not online e-commerce, buy now, pay later, but literally you can walk into an 7-Eleven in Indonesia and soon in other countries and use your Credivo credit limit to pay for a can of Coke. So it's that part and as you know, offline is a way, way, way bigger market than online, similar to in e-commerce. So I think there are some really large tailwinds for Credivo to enjoy over the next decade.
Super interesting. Yeah, I'm a big fan of the Credivo story. Met the founder a few times. So we spoke about kind of two clear success cases. I mean, you haven't exited, so they're still kind of developing, but clearly going in the right direction. But everybody knows venture is a risky asset class, and not every investment goes as per plan. And it's part. I don't remember who said that, but I remember reading quotes of some venture capitalists in Silicon Valley saying, "Hey, if all of your investments go well, it means you're not taking enough risk. So you're not thinking about it the right way." So obviously, I don't want to talk about negatively about any specific companies. I don't want to do that to founders. But can you maybe share, anonymized example of something that didn't work out and maybe why? And what are, maybe just make it a general, what are the usual causes of things not working out?
Well, I mean, firstly, I'll reinforce the point that you said, which is venture is about risk, and on the spectrum of investment classes, it's very high risk, high reward. I think there's analysis done that the best performing venture funds also have the highest in portfolio failure rate. So it's not uncommon for the best venture capital firms to have sometimes half the portfolio not return back capital, because when you get it right, you get it really right. And so that's something I think is important for your listeners to understand as well. In terms of why companies don't succeed, I mean, there's many reasons. The main meta reason that I can tell you is when you're investing early for a company is that they fail to find product market fit. They think that there's a problem that exists that they want to solve, and it's a big problem. And for whatever reason, either the product they can't get right, or the market is not what they thought it would be, and they never make it to the scaling phase. That's the most common reason that we see for when companies don't end up working out. In other cases, it's just a complexity of business model, and it's very hard to scale a company. And an example I can give you is that in this region, we invested in a company that was trying to provide a hyperlocal services platform where you, Michele, could log in and find a cleaner for your apartment, but you could also log in and find a guitar tutor for your kids, or you could log in and find someone to wash your car. And we thought this was amazing and it was going to be of very tremendous value to customers. Unfortunately, it didn't really reach escape velocity as a business, and ultimately it shut down, and we lost a relatively small amount of capital that we'd invested in it. And I think what we didn't realize at the time of investing was, yes, in success it looks amazing, but the challenge of scaling a multi-service platform on a hyper-local basis, because it's not just about, so it's not just like in east of Singapore when someone wants a guitar tutor, you got to deliver that tutor. Otherwise, they have a bad experience. But you got to deliver it at the right time, on the right day, at the time, in the place where they need it. And of course, the business also went through the COVID lockdowns, where if you're a physical service delivery platform, good luck to you. So I feel like it was a complex business to start with, more complex than we realized when we invested. But COVID it was very hard to survive COVID. And so ultimately, the founders made a difficult decision to shut the business down.
I understand, yeah, and yeah, I know it happens. And what as a investor, as a venture capitalist, as we discussed earlier, you need to take some of this risk. You know that some of the portfolio companies you were invested in will not make it. Obviously, the risk is higher at the very beginning, and then kind of, I guess, reduces as the company matures. So I guess two questions. One is for the main fund, so Fund Six in this case, or Fund Five, Four, Three, and Two, and One. How do you think about de-risking from a kind of a capital allocation perspective? How how much capital you allocate to kind of immediate investment versus follow-on, etc. And then secondly, I'm assuming that opportunities fund comes also from this understanding that at a certain point you see what works really well, and if there is and obviously you have a strong relationship with the company, so you have a privileged access to the companies. How do you think about those kind of two parts?
Yeah. So the simplest way to think about it is that you make the initial investment based on a certain risk um, fingerprint, and then any incremental investments in the same company have to be done on the basis that it is continue to de-risk. And so what that means from the core fund, I know I saw you put up a slide showing the core fund and the opportunities fund. In the core fund, rough rule of thumb, we reserve half that fund for first checks, and we reserve the other half to follow on, right? So we make a certain number of first investments, and then there is a strong competition for capital from those portfolio companies to access the second half of the fund. And so in success, most of the follow-on capital flows to the best performing companies. That's really how to make your venture fund really successful. And when we make those follow-on investments, we pay increasing regard to the extent of de-risking that's taken place in companies, while still sort of being anchored to the view of like, can this go really big in success? You can't lose sight of that, particularly from the venture fund. The opportunities fund is quite different. It's a different pool of capital. It's supposed to have a very different risk profile. While there's a lot of tolerance for failure in the venture fund, there is a less tolerance for failure in the opportunities fund. We don't want to lose capital from that fund. And so we have to sort of, when we're investing from that fund, we have to sort of change our mindset. And sometimes that can be quite hard to do. But one thing we have done recently and will be in place for this fund is that we have a different person leading the processes on companies, even portfolio companies, and we have a more rigorous sort of decision-making criteria around it. So this person that's only focused on that fund, who is Ed, will sort of make a recommendation to the investment committee about whether it's that the business has got the upside potential still, but is de-risked enough for it to go into the fund. And on that basis, the IC will make a decision.
Makes sense. Interesting. So let's look forward for a second. We are kind of as the StashAway private equity venture capital program is invested in the new fund, and obviously we are investing in the future in practice. So you mentioned earlier about artificial intelligence as obviously a core topic that you're looking at both for what concerns your internal productivity as well as, I'm assuming, in terms of investment horizon. Is there are there any subsectors that you're looking at specifically within AI or not? Is there any specific investment thesis you have which concerns AI or anything else? Anything you are contrarian in this market? How are you thinking about what you're looking at, what you're really really interested in right now?
Again, two things that may contradict each other. Firstly, I think when we are covering the markets that we're covering, it is my job and my team's job to make sure that we're across every AI company in these markets. So we, from a coverage perspective, we don't need to be too cute about, which subsector. Like we just want to cover everything because ultimately you're looking for that great founder that has that idea in a category that you know and you understand and you want to deploy capital into. Having said that, there are certain types of businesses that we are very excited about. There are certain business models we're excited about, and there are certain business models where we feel like we don't have a right to play as much. So, but even in them there are exceptions. So, for example, a few years ago we said, look, the large language model industry is going to be very capital intensive, and it's probably going to be shaped in the US and possibly in China. And I don't think we expect to have many investments in companies that are building their own large language models. Um, as soon as you set a rule in venture, there's something that comes along that breaks it. We came across a couple of different large language model companies in the last couple of years that we've had access to on a proprietary basis, and we have made investments in large language models. But I'd say that that's probably like the 5% of the AI space. The 95% is really focused on what I would call um, vertical application of AI to transform an industry. So that can be, think of it as like, what does a law firm look like if you built one today? We met a business today, which is, what does a migration agent look like? So if you are to move countries, you usually get someone's help to move yourself and your family. And today that's a person. What does that process and that business look like that you interact with? And where we're finding the best opportunities right now is on businesses that are building what exists in the world today, but building it with AI. And the people joke about the one person company that's going to be $1 billion plus, and I think we're not too far away from having those probably in the next 5 years. We're seeing people sort of use AI to build businesses in much faster and much leaner than they've existed before, and actually to provide a better service level than existing companies can. So that's a space that we're looking at, and I think we're seeing a lot of innovation in that category, particularly in our markets, because there's no reason why that needs to be built from the US, and they're not capital intensive businesses.
We actually, as you know, we actually clients. Actually, I don't know if you know, we're clients of two of your portfolio companies. One is Lorikit, which is also AI focused, and we use them on the customer support side. We're trying to automate some of our processes there. And the other one is Kula, which we just onboarding with. We changed our former applicant tracking system for recruitment, and we decided to use Kula. One of the reasons is exactly because the use of AI is much more sophisticated than some of the incumbents. And so as a selector of software, I can see how that's playing out and how that will disrupt several industries. It's interesting. And I think one of the interesting topics in kind of a topic of conversation in this area is that some of the more traditional companies, and I'm thinking on customer support, the Zendesk, for example, obviously their sector is going to be completely changed by AI. Like there's no doubts about it, and they know. And they are a large company; they have the resources to change, I guess. But at the same time, they probably struggle to attract the right AI talent because the AI talent that is out there would probably prefer to work in a younger company, getting more equity, having more upside, and working in a different environment, etc. So actually, there is a real risk to some of the incumbents that some of these new companies are providing. So I think it's going to be very interesting in many industries. Yeah. One last question, I think, because we have 5 minutes left. And then if anybody has questions, sorry, I lost you for a second. Say again.
No,
Tushar, sorry, I lost you.
Have you got me now?
Yes, yes. You were saying something.
I was going to say that in your example about Zendesk, yes, Zendesk has some disruption threats from AI companies, but don't forget that still a very large part of the ecosystem is contact centers in the Philippines with people in them.
Okay.
So not even Zendesk, like Zendesk is disrupting them. And so I think AI is going to, Zendesk, I think, could potentially pivot into using more AI. It's very hard to change your business model to eat yourself, but they can try. But really, the people that are going to, the businesses that will disappear very quickly are the traditional contact centers, the people shops where there's just lots of people smiling and dialing.
No, no, absolutely, absolutely. I think yeah, I agree, and I think actually specifically for the Philippines, it might be a significant issue just because of how large the industry is. Absolutely. Yeah, I was gonna say actually what my colleagues have just written, which is if you have any questions, please feel free to use the Q&A button. There is quite a few people logged in, so hopefully, so let me know. Happy to answer any question. Otherwise, I do have a couple more questions for Tushar, and we can, we have another 5 minutes to go. Uh, First, 2025 vintage. There is difference. Different vintages provide different returns, and obviously, it's very difficult to understand this before that happens. But I guess that's what we're trying to do here. Can you make the case for the 2025 vintage?
Yes. So macro trends that I highlighted to you are the main reason to stay excited. We are seeing already more and more large companies created outside of the US, and more of those large companies being created in our corners of the world that we cover through SquarePeg. So I think the if you think about the analogy of hunting the big fish, the number of fish in the pond is growing. So it's a good time to be going fishing. Better time than ever. The other thing is that the fishing rods and the bait has become cheaper. And what I mean by that is that we have been through a bit of a market reset. And what that's led to is a cooling potentially of some of the exuberant enthusiasm that was in the market, which impacts things like pricing and impacts things like competition. So today, the competitive dynamics for us that we see on the ground in each of our geographies has reduced from the peaks of a few years ago, which means that now is the time, if we stay the course and we stick to our strategy and we execute well, we can have disproportionate access to the best companies. And also a lot of venture access is ultimately there is an element of at what price do you get to enter these companies. And I think there has been definitely a change in expectations from the market, from founders as to what price they can command. And so we feel like it's going to be a well-priced vintage, where we have more companies that could return the fund and a greater right to win those companies. So I'm really excited about the next set of funds.
Yeah, makes sense. I do agree that it's an interesting time to be investing. There is so many things happening, and yeah, I agree with that. I want to ask you one bonus question. I will assume that in the audience there's somebody that either is a founder or always wanted to be a founder. Maybe working a corporate job or thinking about, using the change in technology that are happening through it. So, and it's not not many people have the opportunity to have a coffee with somebody like you anytime. And so I guess the question is, if you're speaking to a founder that is thinking about raising capital, what is any tactical piece of advice on how to manage that? And you hear a lot of things. There is a lot of kind of a post on LinkedIn about the topic, but I also think that a lot of it is just the self-marketing of people rather than
Mhm.
real suggestions. Given you sit on the other side of the table, what are the core suggestions for people raising money?
To anyone, any listener that's thinking about building a business, you should go do it because there's never been a better time. And with the advent of AI and the tools that we now see, if you can't code, it's fine. If you don't have product design expertise, it's fine. There's an AI agent that can help you do those things. So it's a great time to build. If you want to raise capital, first thing I would say is actually challenge that assumption and say, why do you need to raise capital? Because these days it has become cheaper and cheaper and cheaper to build a company. So really, is that the only way you want to do it, and why? And then I would perhaps not self-servingly ask them like, what to build? Um, there are different sources of funding for different kinds of growth profiles and different kinds of businesses. If taking venture capital, as you know, comes with some strings. When I invest in a company, I'm expecting a certain rate of growth, and a certain outcome in success. And that's not the only definition of success for a business. There are businesses that don't get really massive, but are very profitable and don't have not raised much capital, and those are good businesses. They're just not great businesses with venture capital. So before I mean, part of the advice that I usually give to people when they ask me about raising capital is like, why do you need to raise it? What kind of business do you want to build? And then I use that to try and guide them to what the best source of that capital is going to be, because in many cases it's not venture capital.
Okay. That's good advice. I was not expecting it from a venture capitalist, but it's very good advice. There are two questions from somebody in the audience. First one is, with AI reshaping so many industries, how do you assess whether a startup has a true moat or is riding the hype?
Oh gosh, this is a fantastic question. Look, I think the hype part is easier to answer because I think that comes down to the skill and the judgment of the VC in selecting the team that they go into business with. And I think for us, it is, I can tell you it's very easy when we interact with founders to work out who's really fundamentally building for the long term and who's kind of trying to do it because it's cool and they want to maybe try and flip the business in a couple of years and cash something in. So I think that part I find relatively easy, believe it or not. The question around the moat is a very tricky one, and it's one that we spend a lot of time reflecting on because you know AI is reducing moats. That is the core value that it's bringing. So it's making us really challenge the framework through which we evaluate moats, and where we're landing is that actually one of the moats that's emerging for AI-centric companies is access to the customer. If you have access to the customer, that is, if you have some way of having better access to a customer than your competitor, then you have a greater right to win. Because product, which used to be your moat, is not necessarily going to be the case anymore because building product has become ubiquitous and commoditized, and will continue to become the case. So really having access to the customer, being able to service them really well, having a really keen insight into what their problem is and how to solve it with technology is going to be increasingly a moat.
Interesting. One last question, also coming from the audience, and then, as I promised, I will, close the call on time. Are there any trends or markets that are underhyped and overlooked by other VCs that you think you're picking up?
Well, at the very high level, anything non-AI. It's AI is the belle of the ball, and I think there's many VCs now that are saying unless you're building something with .ai or it's agentic, we don't even want to bother. But I'm looking at a business right now that is building out a store network in one of the emerging markets that we cover for secured financing for the bottom middle of the pyramid, socioeconomic pyramid. Phenomenally profitable business in success, could easily return our fund if they execute well. It's very low risk of being disrupted by AI. There's still a bricks and mortar rollout to get right. But they can definitely leverage AI in their operations to become even more efficient. So I think there's a whole category of businesses that exist that we're trying to cover, that we think could be really exciting. And at Square Peg, we have this mantra, which is we love boring businesses. Like we like sexy businesses as well, but we love boring businesses because they are usually less contested and they can continue to quietly compound in value year after year. And in 10 years' time, you suddenly look and you have a huge business on your hands. So we are continuing to look at AI very much, but even within AI, we're looking at less sexy applications of AI. And then we continue to look very, very clear, very much at the world outside of the world of AI.
Perfect. Look, Tushar, this was extremely interesting for me. I hope it was as interesting for the people listening in. Maybe speaking to our clients listening in, if you have any questions on the private equity venture capital program, please reach out to our wealth advisors or to customer support if you don't know how to reach wealth advisors. If you have any questions about this specific allocation to SquarePeg, similarly, just talk to wealth advisors and they will be able to give you a kind of any answer you might be looking for. Tushar, thank you so much once again, and have a good evening.
All good, Michele. Thank you.
And thanks everyone, and thanks Kimi also being on the background. Thanks a lot. Bye bye.